This video is created by Jagrat Creation. It is on underwriting of shares and debentures. I wish to solve one sum here before you. Look at the sum on the screen. This is the sum which I wish to solve here before you. Gemini Limited came up with public issue of 30 lakh equity shares of rupees 10 each at rupees 15 per share. So shares are issued at a premium of rupees 5. ABC took the underwriting of this issue in the ratio of 3:2:1. Applications were received for 27 lakhs. Marked application 8 lakh for A, B 7 lakh, C 6 lakh shares. Commission is payable to the underwriters at 5% on the face value of shares. Face value of shares. So, just observe. Section 46 of the Companies Act 2013 underwriting commission is limited to 5% of the issue price in case of shares and 2.5% in case of debenture. The rate of commission given above are the maximum rate that could be negotiated. The company is free to negotiate the lower rates with the underwriter. But in this sum, though the issue price is 15, the underwriting commission is to be paid on the face value of the share. That's an important point that students should remember. Compute the liability of each underwriter as regard the number of shares to be taken up. Pass journal entries in the books of Gemini Limited to record the transaction relating to underwriters. So we are also required to write down the journal entries for that. First of all, let us determine the gross liability. This is the details of the sum. Issues of 30 lakh shares. Gross liability is required to be distributed in the ratio of 3:2:1. So liability of A, 30 lakhs into 3/6. Liability of B, 30 lakhs into 2/6. Liability of C, gross liability of C, 30 lakhs into 1/6. This is the gross liability of each underwriter. Give a credit to the underwriter for the marked applications, means applications received by the company at the instance of their efforts. For that credit is to be given. So application is given for marked applications. Notice one important point, that in this sum there is no firm underwriting. So only two distributions are to be made, one for marked and second for unmarked. Unmarked application will be distributed in the proportion of gross liability. So after deducting the marked application, here there is, in case of there is a surplus, C there is a surplus. Now what are the unmarked application? Total application 27 lakhs. Marked application deducted therefrom. So 6 lakhs are the unmarked application. These unmarked applications are required to be distributed in the ratio of 3:2:1. So 3 lakh, 2 lakh, 1 lakh. Here the surplus 2 lakhs will be distributed between A and B. This surplus 2 lakhs will be distributed between A and B. In which proportion? 3:2. Because the gross liability proportion of A and B is 3:2. So 2 lakhs distributed in the ratio of 3:2. So credit given to A 1,20,000, credit given to B 80,000. There are no firm applications, remember. So C is not required to take any share of this company under this underwriting agreement because there are no firm shares, and his efforts for marked application is much more than what was his gross liability under the underwriting agreement. So only A and B are required to take shares. 2,80,000 plus 20,000, 3 lakhs. Total issue 30 lakhs. Application received 27 lakhs. The applications are short by 3 lakh shares, and the liability determined for A and B is 3 lakh shares. Now they are required to pay at the rate of rupees 15 per share. For shares allotted to them. So A is allotted 2,80,000 shares. At the rate of 15 per share, he is required to pay 42 lakhs to the company because of the shares are allotted to him. Same way, B is allotted 20,000 shares. He is required to pay 15 rupees per share. So this is the amount that he is supposed to pay. Now what is the underwriting commission payable to them? At the rate of 5% on the face value. So 15 lakhs is the number of shares, gross liability of A, multiplied by 10 face value. At the rate of 5%, 7,50,000 is the commission to which A is entitled to. Commission that to which B is entitled to is 10 lakh shares at the rate of rupees 10, that is the face value of share at the rate of 5%, 5 lakhs. And on 5 lakh shares at the rate of rupees 10 per share at 5%, 2,50,000. So this is underwriting commission that they are entitled to. A is supposed to pay 42 lakhs for allotment of shares. He is entitled to have a credit of 7,50,000 for underwriting commission. So A is required to pay 42 lakhs minus 7,50,000 that A is required to pay to the company. B is required. A is required to pay, or the amount is receivable by the company from A. B is entitled to pay rupees 3 lakhs for allotment of the shares. He can adjust his claim for underwriting commission to the extent of 5 lakhs. So company has to pay amount payable to B by the company 2 lakhs, and similarly amount entitled by C. So company is required to pay C rupees 2,50,000. Now let me write down the journal entries for shares allotted. A account debit, B account debit, to equity share capital account credit, 3 lakh shares into 10 each, to security premium, 3 lakh into 5. So equity share capital account credit and security premium account credit being shares allotted to underwriters as per underwriting agreement, that is the narration. Now they are entitled to have underwriting commission. This is underwriting commission, 50 lakhs is the underwriting commission payable to them. So underwriting commission account debit to A's account credit, to B's account credit, to C's account credit, being underwriting commission payable to underwriters as per underwriting agreement, that's the narration. Now this is the amount to be received from A, this is the amount to be paid to B, and this is the amount to be paid to C. Now amount received from A. Bank account debit to A's account credit. Narration. Amount received from A against the allotment of shares after adjusting underwriting commission, that's the narration. Once again, amount received from A against shares allotted after adjusting underwriting commission, that's the narration. Amount paid to B, B's account debit to bank account, being amount paid to B against underwriting commission after adjusting the amount due on shares allotted. And C, bank account debit, C's account debit to bank account credit, being underwriting commission paid to C. This is the narration for C. So this is how you can write the narration in your own language. I have tried to explain you this sum. I feel that you have followed all these things. Thanks to all.